Hello, business owners. My name is Jennifer Parrish. Get ready, set, let's retire. Today I'm going to walk you through 3 steps on how to set up a retirement plan for your employees. To break down these 3 steps, we're going to go through a plan selection, installation, and administration of the retirement plan. Your first step for the qualified plan selection, you want to make sure that plan is attractive, that will be able to retain and reward employees. You also want to make sure it's cost effective well on the administration end, also with the employees and the employer, which is you. You want to make sure it's flexible and also provide tax advantages. Also, at this time, you want to make sure that early retirement is in place if needed. Part of the plan selection, we're going to look at pension plans and profit sharing. As an employer, you can offer one or the other or even both. With the pension plans, the payment for retirement is guaranteed. The employee cannot withdraw. As an employer, you must fund this plan. There is a minimum contribution. Employers may invest up to 10%. An employer may only limit to 25% contribution annually. Now, with the profit sharing, as such as 401ks, accounts of that nature, it's deferred compensation, which is a tax benefit for your employees. They may borrow after 2 years. Employers, you are not required to fund these accounts, but you can do 100% investment. But also, the same as pension plans, there's only a 25% annual contribution that you can do offer for this plan. With pension plans, you, as the employer, are investing in your employees 100%. This slide breaks down the qualified pension plans. You have four: the defined benefit plan, the cash balance pension plans, the target benefit pension plans, and the money purchase pension plans. These plans are broken down to show you as the employer who contributes and the employee who does the contributions. Profit sharing plans have contributions from the employee and sometimes the employer. As an employer, you may decide to match. There's income tax liabilities, the traditional IRAs, after tax, which is Roth, and there's a variety of plans. You have the company stock, cash contributions, contributions pre-tax, 401ks, contributions post-tax, 401ks, but this is Roth or thrift plans. As an employer, you really want to make sure that you understand the plans that you're offering because it doesn't just affect you, it affects your employees as well. As I did with the pension plans, here is a summary for the profit sharing qualified plans. ER, again, is for the employer. EE is for the employee. And it also breaks down which contributions the employee or employer may offer and who's responsible for what. Establishing and adopting a plan. You have 4 different plans that you could choose from. You have the volume submitter plan and the individually designed plan. The volume submitter plan is a combination or a split between the prototype and individual plan. You need a customized plan. It's done by a CPA, attorney, or a third party. Now, the individual design plan is a little bit more costly. It breaks down specific needs, but depending where you are within your company financially, you may want to go with a volume splitter or go over to the master or prototype plans. The master and prototype plans are pre-approved by the IRS, and the other two, the volume splitter and the individual design plans, are not pre-approved by the IRS. The master plan has single trust or custodial accounts. The prototype plans are separated trust or custodial accounts. As the employer, your job is to make sure everyone that is qualified and not qualified, depending on the circumstances, through notification. For example, you have 2 different locations. One location has been open for years. 25 of those employees are qualified for the particular plan that you chose. Those employees must be notified, and the ones in that particular setting has to be notified while they're not qualified. Now, at your other location, you have had it open for maybe 6 months and maybe have 10 employees, and those 10 employees, none of them are qualified. No notification needs to be given to that other location because no one at that location is qualified. We are now at the final steps for establishing our plan. The qualified trust, a trust established or organization in the United States, is maintained by the employer for the employees. The custodial account is maintained by a financial institution or other bank, and it must be non-discriminatory. Also, investment plan assets. You have to decide who is going to manage this plan. You, the sponsor, or the individual of the plan participants. You also must make sure that there is a broad range of investment choices and understand the responsibility of the fiduciary. Now we're at the final steps, the administration. It takes continued management at the administration part. Let's talk operating of the plan. This is where you are covering those eligible employees, making sure the contributions of the minimum requirements are maintained. And those are for those pension plans, the money purchase, the target benefit plans, quarterly contributions, and there's a predetermined formula that you would use to make sure everything is consistent and where it's supposed to be. As an employer, you may come into circumstances that some of your employees still may be considered as self-employed. The contributions and deductions formula is different for those that are self-employed. There's a limited deduction. Deductions cannot exceed, 25%. They have what they call a Cohen plan. Simple name for a qualified plan. You want to know the schedules, the different forms that you need to use, and any excessive contributions can be carried over into the next year. A part of your administration work is to make sure you understand your forfeitures, your prohibited contributions, and also the prohibited transactions that can be done within your plan. You want to understand the forfeitures, defined contribution plans may reduce plan costs. It can also reduce plan costs for the defined benefit plans. But for the contribution plans, it actually, your forfeitures can be allocated to the remaining participants. The prohibited contributions are not permitted between a plan and a disqualified person. A disqualified person, for example, can be anyone with direct or indirect personal ownership of 50% of the company. Prohibited transactions, sales, exchange, or leasing of any property between plan parties. Employment, Retirement, Income Security Act of 1974, also known as ERISA, and following requirements are what we're going to go over on this slide. You want to understand, as the personal administrator of these plans, that there are certain requirements that you must follow. Act and care of, skill and diligence within the interest of the plan's participants and the beneficiaries. You cannot get paid. If you are receiving full-time pay from the employer or the union, you cannot get paid for being the fiduciary of a plan. Periodic pension benefit statements must also be sent out to the individuals and the beneficiaries, depending on how it is set up, annually, quarterly. We have to make sure those statements are sent out. Just like anything that we do, there are rules that we have to follow, and there are people who are there to enforce the rules. The Department of Labor and the Pension Benefit Guarantee Corporation. Yes, guarantee. We have to make sure, as an employer, we are following the rules and establishing things for our employees to have a better life at the end of retirement. There is required reporting to the Department of Labor and certain forms that need to be filled out depending on the situation. On this page, I have delegated a summary of forms for you, and it breaks down the form number and why it needs to be filled out. How do you feel as the employer? Yes, a lot of this may seem overwhelming, but once everything gets established, you are in control. Follow the steps that you need to. If you need any more information or have any questions, please reach out to me, Jennifer Parrish. Again, ready, set, let's get our employees